Okay. Hello, everyone. I'm Dave Govin. I'm an executive in the tech industry, and I'm also a new client with Quantel Asset Management. I want to welcome you to today's webinar. I'm very excited about the topic today. We're basically going to be discussing how Quantel is leveraging AI to create an advantage for growing wealth 5x. I'm happy to now introduce our presenters, Sham and Jerry. Sham has had very impactful positions at Morgan Stanley for over 23 years and now leads Quantel. Jerry is a former trader for Shanghai Securities, and he's an expert in quantitative analysis for finance. Let me turn it over to Sham.
Thank you. Thanks a lot, Dave. Really excited to welcome you all to our webinar. And today is going to be a very exciting webinar talking about what the market is presenting as an opportunity for all of us. Are we capturing all that or not, right? So let me start with a $1 million question or a multi-million-dollar question, right? Do you think you will have enough saved before you retire, right? The portfolio is growing. Is it growing at a healthy pace? Is the primary objective of what we are going to be talking about. And what tools do you have that is within your access that, in this modern day, with everything is AI, everything is tech driven, could you leverage some of these things to help you answer this question? Do you think you'll have enough saved before you retire? And as far as who we are, meet us, Quantal Asset Management. We are a SEC registered investment advisory firm based in New York City, not too far from Grand Central if you guys are very close to New York. We are an AI powered wealth tech platform, uh, primarily meant for accredited investors. Our mission is to democratize the systematic investment, the art of that in our day-to-day practice, the use of discipline in investment approach, and not to make it emotional driven and mostly data driven approach. And we want to level the playing field. This is what exactly hedge funds do for a lot of wealthy institutions, very ultra high net worth individuals, and so on. How do we democratize that? That's our mission, and we've been really successful at it. We'll talk about this in a bit. So primarily, we have a research portal that everyone can use. It's about what's moving the market, which stocks, which sectors are actually having the momentum under its wings, where's the value that's yet to be captured, etc. That's a research portal. Then we have the advisory, where we link up your account with the portal to provide you a lot of financial insights about your portfolio, something that's not very clear in plain sight. So we use data to be able to analyze the portfolios, etc. And then the last but not the least is we are fiduciary money with money management. So we are acting as an investment manager for a lot of different customers on various different types of accounts. So that's us in a nutshell. What we are going to cover in the next 40 minutes or so, try to understand the basics of why a portfolio underperforms. Do we have clarity on that in terms of going into, it's like going to a doctor. Before we go to the doctor, you take a lab report to find out how the health parameters, the cholesterol, the blood pressure, and all those things are there. It's exactly that. How to analyze a portfolio in terms of health check of the portfolio. And we are going to talk about our framework called X-ray, which is exactly that. It goes into the deep insights of your portfolio, deep details of the portfolio, and give you that insights. That's X-ray framework. It's AI driven. I will talk about that in a bit. And then what the next steps are in terms of how you can leverage our tools and our skill set to help you achieve your financial goals. And last but not least, we'll have a Q&A to answer any questions that you may have. So key benefits of working with us. We have achieved over 50% returns in many portfolios over the last 18 months. We have both recommendations and fully managed. So we don't have to necessarily manage your portfolio. We can give you the tools and tips that you can work with your existing financial advisor. So we can play a role of an auditor in that regard to just basically give you the tips that you can ask questions to your existing financial advisor. At a minimum, you'll learn a lot, or you'll go with a lot of insights about your portfolio while you plug your portfolio details with the tool like X-Ray. So that's basically what we are going to talk about in the next 40 minutes. So now, is this for you? Let's get started there. Are you the typical person that can benefit from what we are going to talk about, right? If you're an individual with $500,000 or more in your retirement account, and you're not sure where you are, how you're performing, you have your money in a very large investment firm, and you're not sure how you're comparing with your peers, as an example. And if you have worked over, I would say, 15, 20 years, over the period of time the market has given certain growth, we estimate that your retirement account would be at least $500,000, if not more. So if you are that kind of a person, you're going to get a lot out of this webinar. If you're not that person, if you've got a lot more, great, pat on the back. If you've got less, no sweat, you still have a lot to learn out of this. So stick around and see if we resonate with you. So there are two types of investor categories when we work with folks. One is folks who want a peace of mind in terms of knowing they are going to be fine. They're probably around 40, 45 years old. Retirement is still 15 years from here. Time is money, right? Time creates money also. So we don't want to lose too much time thinking we are going to be good. So we just want to have a peace of mind, ensuring that we are on the right track in the trajectory of like retirement path. The number two is people who want that early retirement, knowing that they've got enough money that's going to not only be enough for them to have a post-retired life, say until they are 85, 90, but also have a good legacy to pass on to their grandkids, etc. So that's type two. So you could be any one of those two types of the category. There might be a lot more types here. We are not trying to oversimplify it. It's just at a broad level, we think that if you're one of these two types, you can get a lot out of this webinar. So why traditional financial advice may be failing you? So before we go there, let's take a quick poll so that we get some feedback from you guys in terms of do you feel you have enough in your retirement? So it's more of a retirement confidence. How do you feel about your retirement? That I'm confident, I'm really well positioned for retirement whenever it happens, maybe 15 years from now, 10 years from now, or I'm not confident, I'm somewhat confident, I'm not confident, I'm not sure. So let's keep moving. The harsh reality that most of us face is when you trust a large financial firm, we get a feeling that we are just bucketed into one of those big buckets of, okay, you are this type of category, you're a 60-40, 60% equity, 40% fixed income, regardless of what your age is. Your portfolio may not be performing or taking opportunities that's in front of us. Market might be giving a great return. Last year, S&P did almost 24% return. We may not have had that kind of returns on our retirement account. When you're managing things on your own in Robinhood, you may have great returns, but your retirement account given to a professional advisor may not really be performing well. Why? Possibly because you're being underserved, because you're just bucketed into one of these big big categories. They're not really customizing or incentivized enough to take advantage of all the opportunities, right? The other one is inadequate risk management. Your portfolio might really be in like one single speed. It's just no matter what the market conditions are, you're just going to be invested in the same list of securities or products. It may not actually do all that well. And the third one, a lot of us face, particularly in IRAs, is DIY, do it your own. We hear from various different groups, social media, this stock is going to go well, that stock is going to, we go into a party, someone says something about it, we then invest, we're usually the last person to get into the mix, and we are the first person to burn our fingers in terms of it's already run up, and we enter the party too late, and we actually lose a lot there. So those are the typical hardships that we face as far as the investment returns are concerned. So part of it is also to do with why most of us don't feel where we are, right? That's the portfolio performance. Is one is lack of planning. We just go with the flow, and we just have a gut feel. It's not data-driven feeling. Oh, I'm doing well. Last year I did well, but hey, how is it going to be doing for the next 15 years? Is it really positioned well? Is the data supporting you, right? Do the advisors that you currently have provide those kind of tool set for you to really project out from a data-driven, what is going to be your portfolio value when you turn 60 or 65, whenever you think you're going to retire? So do you have those tools available in your existing investment advisor? Most often than not, the answer is no. And that's the kind of problems that we need to solve, right? The difference between a well-managed portfolio and an average portfolio is that's the difference, the 5x difference. You have a certain amount of money, you want to make it like 5 times in the next 15 years, if assuming that we have 15 years in front of us. How do we get that return is one, in our statistical analysis, right? Again, as I said before, market gives a lot of opportunities. Are you tapping in those opportunities? Is it actively managed? Where is the momentum right now in the market? You can say that, clearly there is a tech-driven momentum that's there. Are we joining the party late? Is market really going to start turning, the opposite direction? Should I be hedged or not? That's active planning. Most of our traditional financial advice are not suited for that kind of active management. The second one is regular rebalancing. Things may have run up quite a bit. Profit taking is always a good thing, because what you don't want to see is portfolio going up in value and coming down back, because what goes up will come down. So along the way, we need to take some profit taking. If you just trust a mutual funds to do it, probably you won't get all the benefit there. So that's the other area of like a well-managed portfolio's attributes. Whereas an average portfolio, you just have a limited oversight. You're just in single direction, unidirectional view, set in like one or two different portfolios, mutual funds rather, and it's just not performing, or it's not performing consistently across the multiple different time periods. So that's passive allocation, at worst, and we want to avoid that in our portfolio, creation. So why we are focusing so much on retirement account? Why not on my personal account? It's great. What we say is applicable to individual accounts also, but why it's more applicable to a retirement account is because that's the biggest growth opportunity that one may have. Because retirement is sort of like a fixed time period. As time moves on, the ability to produce new money for an older person is lesser. At some point, they want to say, hey, I want to just enjoy life. I don't want to keep working like this, right? Most of you guys on this call are people who are executives in your firm. You're active, busy, and whatnot. At some point, you really want to take it easy. Now, retirement account also has the benefit of compounding. It's going to, give enough time for you to recover from a bad year, as an example. So that is the biggest opportunity in terms of long-term potential. Whereas a individual account you may have some expense, college tuition to pay for kids, etc. So that kind of impact is not there on the retirement account. So you've got the biggest compounding growth potential, excuse me, on the retirement account. So with clarity offered with the tools, with enhanced planning, with dynamic adjustment, you're bound to succeed. So that's what we have built as a tool that one can leverage. So if you're feeling like this, going on a golf cart at like 20 miles an hour on a highway where everyone else is moving at a much better pace than you, or your portfolio is not doing as well, you just go, you're like really like you're making progress, but not enough. right? Your portfolio is growing, but not enough, right? One day it's growing and second day it's coming down. So that kind of impact, if you feel, you're not alone, right? That's what you don't design a golf cart to go on a highway. If market is providing an opportunity like a highway at different points in time, it could be a construction zone also, right? Market could be on a downward slide. You want to slow down there. That's what we call it as dynamic allocation. So you want to be able to adjust your portfolios to take advantage of the market, whether speed up when market gives an opportunity, slow down when market is really taken those opportunities off. How do you preserve your capital during those phases, like what happened in 2022? And that's the trick in terms of how do you make your portfolio grow 5 times from where you are right now. So breaking down in terms of numbers, the difference between a 6% versus a 10% annual return. So this is not anything fancy. I'm not talking about 25, 35% return consistently. You cannot achieve that. That's a fact of life. But if you say S&P off late has got 10% return in an annualized manner because it's been going great. But over a much extended period, S&P has got about 8% return. A typical retirement account, because of the mix that it has with a lot of other asset classes, particularly fixed income, is got only between 5 and 6% return. That's statistics, right? So now what is the difference? So suppose we are able to make small adjustments to our portfolio, nothing fancy, nothing magic, no snake oil. We are just going to get 10% return, right? Annual return by just being a little bit more diligent about where we are with the portfolios. Now, if we did that, we've been able to beat those expectation of 10% in a significant manner in the last 3 years, thanks to the market. But if you say 10 years in the long, 10% in the long run, what does that difference really mean? Extra 4% return. I'm assuming that we have about $500,000 to start with on the retirement account. If you have a lot more, the difference is going to be accentuated even better, right? If you have $1 million, now this difference is going to really exaggerate a little bit more because you have got a higher starting point. Now I'm going to go with a 500K as a starting point here. You have a 6% annualized return in a traditional financial advisor based, investments. And whereas you have 10% when you have tools based investment where you're guided along the way before you reach your retirement age. Now, if we did that, and I'm assuming that we are still contributing to our retirement on a monthly basis, which is $2,000 per month, which is about currently the Fed is about 401k is about 23 grand per year, but you also have IRA that adds up to 7. So let's go with a simple assumption of $24,000 as an average, and that divided by 12 is $2,000. Now, if you have $2,000 starting with 500K with a 6% CAGR or the annualized growth rate, we are talking about ending in 15 years' time with $1.6 million, let's say, right? $1.6 million. Now, compare that with having a 10% CAGR or the annualized growth rate of 10% in a consistent manner. So some years it can be 20%, some years it will be negative, it doesn't matter. So average we are talking about is 10% return. So you're talking about 2.6 or $2.7 million here. Now that's a significant difference there, right? That extra $1.2 million is a treasure, particularly when you reach your retirement age. That is going to continue to compound for the next 15 years of life or 20 years of life, depending on when you retire. So when we think of 65, let's assume 85 as the age group here, that extra, that $1.2 million continue to grow, and that becomes your legacy that you're going to give to your grandkids or your kids. So the difference of extra 4% is not a trivial difference. A lot of people, a lot of us fail to understand that compounding is the magic here, nothing else. And this is two words of wisdom from greats. One is from Bill Gates. Most people overestimate what they can do in a year and underestimate what they can achieve in 10 years. So again, that is to do with the effect of compounding. So we think, oh, I can get great returns in 1 year, but can you make it consistent? But that consistency, because of compounding effect, really, makes that night and day shift in your portfolio. The other is from the all-time great of Albert Einstein, saying that compounding is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So if we have lost those compounding effect until now, that time you never get back. It's any day that's gone is gone. It's in the past. So what we have is only what in front of us, and we need to really take that compounding seriously, or that extra bit of like difference to achieve that 10% return very seriously, to not lose that, to be able to take that to work for our benefit in the long run. So with that, I'm just going to show you the consultation QR code. So we are open to chatting with any of you that's interested. If anything that I've said so far has resonated with you, please look at this QR code, take this QR code, scan it, and you should be able to get into a Calendly link, schedule a simple 30-minute, free form conversation with us, and we will be able to just tell you what we can do, if we are the right match for you to discuss with us or not. And we'll be very open and transparent about it, right? So our goal is to be able to make a difference uh, to your investment in general, retirement account in specific, right? As I said, we can just give you tips that you can work with your financial advisor, or we could actually manage your money to the extent that your money is in IRA. If you have got most money in 401k, we can only help you with giving tips and suggestions that you work with. But if it's IRA, then clearly we can manage that money. So let's shift gears a little bit here. Now, I've been talking in a broad sense of how important it is for compounding your growth. We're going to go a little bit deeper with our team member here, who is an expert in quant finance. He's got a master's in quant finance from Rutgers. He's been practicing the art of investment using data and AI and a lot of quantitative finance. So we are having a team of quant finance engineers led by Jerry Yuan, and I'll just pass it on to Jerry. Jerry.
Okay, so thank you, Sean. So now let me take you behind the screen, okay, into how our systematic framework actually works. So right now we call it the X-ray, and it is exactly what it is doing. It's an X-ray of your portfolios, your retirement account. So just like a medical X-ray reviews what's happening inside the body, right? Our framework reviews what's really going on in your investment. So by just very simply link your account, right? We don't need to manage your account. It's just a link account, just one click, we will be able to run the X-ray scanning. So we have built this using advanced quantitative financial models. So the goal is to analyze any portfolio and project a ballpark range of its value over the next 10 to 15 years. But more importantly, it shows the strengths and weakness of your existing portfolios. So whether the portfolio is positioned to take advantage of market opportunities, or whether it is probably risk averse, risk protected, and what is it truly expected to achieve over the long run. So this is where data replace guesswork. Right. So what exactly does X-ray deliver? Well, first of all, it is 100% data driven. We are taking almost all very not just traditional, also those metrics developed by us, feeding into our engines. And from that, you will immediately get the diagnosed scorecard across multi dimensions of your portfolios. So we will walk you through it in next couple of minutes. And then after that, it will produce the overall score that summarizes the portfolio health of your existing account. So the engine will then predict how your wealth will likely grow in the next 10 to 15 years, or let's say 20 years if you stay on the current path. So that's here where the most important part is. You don't just get a report, you get specific actionable insights once we run the X-ray. So you can do those corrective actions and to bring your portfolio back to full health, or you can hand over to us. We manage for you. So So think of it like a doctor prescription medicine, right? The X-ray tells you what pills you need to do to take, and for your portfolio, you do those actions, and immediately you will benefit from that. So now let's look at the 6 dimensions our X-ray portfolio analyze do. Okay, the first thing is the portfolio scores. So are you keeping up with or beating, let's say maybe you have the benchmarks yourself, or let's say you want to achieve a certain goal in the next 10 to 15 years, right? The performance score will tell you if you can keep up with that. So the second one is a diversification score. So are you overexposed to any one area, such as a big technology sector, or too very conservative? So this diversification scores will tell you the potential risk in your portfolio. And the future growth potential score is your portfolio position for the next decades of opportunities, right? Every 1 month we can run that, see if this is gel with our goals, right? So the fourth one is a stability score. So how consistent is your performance over time? So we find a lot of clients, their retirement account rarely beat the benchmark. They want to beat the SP 500. For some year, they don't imagine that to beat every year, right? But they at least maybe 1 out of 10 years they want to see the performance looks good, but it's rarely beat the benchmark or the goal they set. So the stability score will help you understand your performance over time. So the fifth one is financial health score. So if this is an equity strategy and you invest more than 50%, 60% into the equity market, you need to understand those companies. Are they fundamentally solid? Is there anything we can take action to replace those symbols, right? So the sixth one is a downside protection. How well is your portfolio shielded from big market drawdowns? Right? We don't want to have too high exposure to those very risky sectors or styles, right? Because this is entire account. So the protection of the downside risk, we should prioritize. So after we combine those 6 into one single scores, again, you know that just like a body can't be healthy if even just one organ is struggling, right? So a portfolio cannot be strong if one of these dimensions is weak. So this whole process ensure you get the full picture and how exactly and where to focus. So yeah, Sean, so that's the technical backbone of quantile portfolio analyze framework. And and it's now let's take something abstract like how, do I have to have enough to retire, right? And based on this framework, it will translate into hard data and clear answers. So why not, Sham, you can take over and
Right.
about the real case we have. Yeah.
Right. Thank you. Thanks a lot, Jerry, for that insight. So as Jerry was mentioning, so this is like a blood report for a health. In this case, it's an X-ray report for internals of the portfolios, to go and find out what exactly might be suffering, might be hurting, to find out the specific kind of pills to go and address. And that's exactly what we have done here. And these are real accounts that has performed over multiple different periods. This is over a 2-year period. This is over a year and a half period. This is over a year period. All different types of accounts, different risk profiles of different customers. So getting into the specifics of like how to construct a portfolio in a very scientific sense, quantitative sense, using data and using emotionless approach to investing, without any bias, etc. You can see that consistently you can outperform. Here, the benchmark is S&P 500. As Jerry was mentioning, a lot of financial advisors don't dare to compare themselves with S&P 500, right? Because that is a very different yardstick to meet. Now, if you can beat S&P 500, which is work, but it is achievable, at least using data, you should be able to achieve in some of the years, if not all the years. So the difference, just keep compounding, the compounding effect I was mentioning before actually starts showing up in real results. It takes some time for us to like take lead. Once you have enough lead over the benchmark over a long period of time, now you're starting to talk about a 3x versus 4x or 5x kind of a portfolio value. And it's about the discipline of investing using data. Just like what hedge funds do, we don't take the same amount of risk or suggest same amount of risk like what hedge funds do. For example, they take enormous amount of leverage. We don't do that. Those are the kind of things that we are fiduciary. When we recommend things, it's just going to be what is within your risk profile rather than taking too much enormous risk. So it's what is liquid, what is tradable. You want to get in, get out within no time. That's the kind of investments that we are talking about. Now, so this is, like I said, this is a different time period and the kind of return. I'm going to show a real account here, real use case of a person, a customer that we have. It's an IRA account. This is about a time period of 1 year, and I've shown the graph here on the left here. Starting account value in this particular case, he's an executive in a large firm, $1.11 million in an IRA account. Current account value is 1.52 in the last 12 months, right? So that's close to $400,000 that got added to the account. And a lot of thanks to S&P returns, 20% return is a significant return. We said S&P on an average gives about 8% to 10% return. So this year, last year has been a great year for S&P, 20% return. Now look at this. The portfolio returns that we achieved during the same period is 36.83%. It's almost, not exactly, almost double of S&P return, right? If we had 40%, it would have been double, but we didn't get 40%. So we got 36 in the 12-month period. Excess return of S&P is 16.74%. Now, what does it do for your compounding effect in 1 year? That the amount of extra money that you got, the additional account value is $122,000 more than S&P, but the growth of the account itself is 400K, as I said. Now, if you let this 122K compound at just even the average 10% CAGR, not every year is going to be an S&P year of 20%. So we realize that if we have 10% as our annualized growth rate, compounded annual growth rate, we are talking about that one single year difference is going to contribute extra $500,000 in the retired year. So somebody is retiring in 15 years time. Now this 122K has translated itself growing to more than $500,000. So that's the beauty of compounding and the beauty of using investments with all these financial health parameters as your guide. Just to reiterate that point, it's a Fortune 500 director with 1.2 million invested with a big name advisor. He was consistently underperforming before, right? He didn't have a good answer from the investment advisor. There always some way that he was being directed with all kinds of complex terms that the investor didn't understand. So they were able to just get by for almost 10 years. He was feeling ignored though, that why are everybody talking about great performance but not me, right? What's so different about my portfolio that I'm not able to achieve? Frustrated, watching friends' portfolios grow faster, concerned about having good enough money for retirement. And then we talked to them. We were able to make a difference for his portfolio. In this case, we are managing his portfolio. As I said before, we can also give the tools and tips using our tools, using our advisory on a regular basis that you can use to work with your advisor, with your portfolios, to get at least have that extra insights that you can talk to your advisor about. So portfolio grew 36% in that 12-month. Risk reduction is 20% because of the dynamic adjustments to the portfolio. We don't just go with like a single view of the portfolio. As market changes, your portfolio changes too. And the additional wealth that got created in this 12 months is $400,000, which is almost half of what he had to start with over a 10-year period, right? So you got to take advantage of market opportunities as market opportunities come. So this is a quote, a real quote from one of our customers. I was paying premium fees for sub-premium performance. My friends with similar positions were outpacing me, and my advisor couldn't explain why. With Quantel and their disciplined team, I went from feeling overlooked to feeling like I finally have some advantages, same advantages as the ultra wealthy. I'm now on track with 5 years to retire in 5 years earlier than planned. So that is a real life example of a person that we have made a difference for. So what do we do? How do we approach this? How the Quantal process can work for you? First, we'll do a free analysis of your portfolio. Right? You link your account. We have this OAuth technology that you might be exposed to. With your bank, you can link all the other investment advisors, same technology. We don't need any of your credentials or anything like that. You just link your bank with your credentials. We get the data from that other place as a read only, meaning we cannot make any changes on those portfolios, but we get a daily update. So that way we can actually be a guardian of your portfolios by monitoring it on a regular basis. But before even that, we will just do an analysis of your portfolio. Just even a statement would do well. And then you will consult with us with a strategy consultation, a simple account setup, which really takes 2 minutes to set the account up. And then we will use the X-ray implementation to go and probe your portfolio, going back in time to be able to look at how your portfolio has performed with regards to a benchmark like S&P, and then how we can optimize it on a regular basis, giving you that extra bit of peace of mind. Again, I'll stop here for a quick pulse check. Hopefully you still are with us, and you can click on this QR webinar code for a free 30-minute consultation with us. During that, we would just talk about, we won't even link your portfolio at that point. We'll just discuss where you are, what you need to achieve, etc., and see whether we can actually help you in that regard. Then going a little bit further, we would give exclusive bonus for those who book the call today. So we have an AI agent as part of our portal that can actually understand your portfolios, your holdings, your interests. You can also put your top stocks that you like to follow. So AI agent will keep that keep track of it and provide you a lot of alerts and insights about that. And we also have a Quantal AI weekly top stocks for people who are DIY, just want to play around with like investing on their own. And Robinhood, for example, you can get a lot out of it because we do look at like stocks that's trending upwards in various different sectors that you can keep a watch. So we have a 3-month kind of outlook on these stock projections. So almost 70% of our projections actually are positive in terms of profitable returns. So you can potentially benefit from it if you invest, but at least you can track it for out of curiosity. And then we also will give you a 3-month subscription to our estate planning tool. This is a tool that actually looks at your current value across the board, project it out with a lot of scientific analysis using Monte Carlo simulation, a lot of things that our quant finance engineers would do, and then project out where you're going to be at various different phases of your life, 60, 65, 70, 75. At what point you need to start converting to Roth IRA if you think you can. I mean, the tool will suggest that these are the most optimized way of like managing. And when you think, okay, at the age of 90, when I want to pass on my wealth to my kids, grandkids, how much wealth, all that projection is a scientific manner that we have, and we'll give you free subscription for that for 3 months. So our core principles in Quantal investment is 1, discipline. It's a data-driven approach, not a human bias approach. There is a lot of data, thanks to finance, thanks to all the history that we have about each and every sector, stock, etc. So we use that data or basis for us to be able to provide a data-driven signals, analysis, recommendations, etc. The expertise here is from a dedicated team of quantitative finance engineers. We've got quite a lot of experience managing money for a lot of high net worth and wealthy individuals, even accredited investors. We would work with you no matter where you are in the journey to be able to get to that. You don't need to be a millionaire to become one. And how you become a millionaire is start somewhere and have that discipline to get there. And the other one is one of the key principles is we don't count on like one single egg for us to mature. We diversify. We put that into multiple different baskets to ensure that your growth is consistent and it's not a fluke. And that's a key aspect of our investment advice. Investment philosophy, we generate proprietary signals using our framework that we talked about before. We give expert oversight. We give dynamic risk controls, and we get global multi-asset diversification. We give a little bit of exposure to alternative asset classes too, so that we don't lose those opportunities. Now crypto has got great potential, at least in the last 1.5 years, it's been going good. So giving a 2 or 3% exposure is perfectly fine. It doesn't really, it only accentuates if that area continues to grow, so we don't lose out on that. So things like that we do across multi-asset and alternative investment classes. So we generate signals, we rigorous validation. Everything that we do is back tested, going back to 2015 or 2018 in some cases. So it's quite a lot of like back testing that we do with our engineers. And we give professional oversight on a daily basis on portfolios that we manage or we advise. And we give you systematic risk hedge as tools and tips. When we advise, we just give you the tips on a timely basis. But when we manage, we act on it on our own. And the last but not the least is data privacy. So we take that very seriously. So whatever data that we have is extremely secure, encrypted. Your credentials are first of all not with us, so that you can definitely have the sense of comfort there. But even whatever portfolio, we don't know the account number of a portfolio or anything like that. But whatever the holdings there, whatever the size of the portfolio is, that is all kept in a vault with high security. So there's no issue there. So with that, we come to the end of the webinar. Again, we'll put this up in front of us. And if there is any Q&A, I guess the Q&A chat is open for people to ask questions. So Dave, I guess I'll turn to you to come back and ask questions on behalf of the participants. Yeah. Thanks a lot. Yeah. Sure. So here the call to action here is to meet up with us. So the first step is for us to talk to you as an individual, to understand where you are in your investment journey, right? How many years do you have in front of you? Just at a high level, right? Nothing's too specific there. But once we say, yeah, we can use our X-ray tool to guide you, then it's a process of setting up an account in Quantal portal, which takes literally 2 minutes to get the account set up. Then you link your existing account, be it in Fidelity, Robinhood, E-Trade, Ameritrade, name it, right? Any and every bank, there are 3,000 different institutions that we can connect to automatically. And it's the same technology that you're probably exposed to from your bank or any other financial software, that you can link up all your accounts in one place without compromising on your credentials. Your credentials to your bank stays with the bank. What they do is it's called OAuth technology, OAuth. You can Google that. What it does is basically you log in using your financial house's portal, like your user password, etc. But you're telling them, hey, exchange a token with Quantal and let them know my holdings are. Don't give any of my credentials. So once we get the token, we are able to exchange the token for data about your account every day. So it's a little bit technical, but I don't want to go too much detail. But what basically it means is you can bring all your accounts into Quantal as a single place that you can view about the health and the performance of those portfolios. Which of these accounts are performing well versus the others that you're holding, that you can do. You can look at how the portfolio is performing today across all these different places. You may have an IRA account with one bank. You may have one advisor. You may have a 401k with a different advisor, etc. So you can link up all these. You can do a compare and contrast using Quantal. And with that, you can also seek Quantal's X-ray advice on how is my portfolio doing across the board.
When you guys are operating, like how can I feel safe with in using your solution?
If to the extent that you want to continue to use Fidelity, your money stays in Fidelity. You're not giving your money to us. You're only asking us to analyze your portfolio. We are not touching your portfolio, right? So you can continue to have that comfort of Fidelity, except that they may not be performing well for you no matter what, right?
Yes.
Maybe with your inputs to your advisor at Fidelity, you can change that course and you can make it perform better. So now you've got a say on how your portfolio needs to perform with our tips and tools. And maybe your advisor say, hey, that doesn't work. This is a different strategy or philosophy. They can have a conversation with you. Now we at least aid you with what you can ask your advisor to work with, but your money stays in Fidelity. We are not touching your money at all. In fact, we cannot touch your money. That's the other thing.
Understood. And do you also do you work with Schwab or something? I thought
everybody, just 3,000 different, and that list is growing. We use a company called Plaid, and they are the most popular among the providers of this service. So that allows us to link your account. Once you have Quantel, we use Plaid. You say where you have your money, whether it's Merrill Lynch or Morgan Stanley or a Fidelity. So we can just link all your accounts regardless of where it is.
Yes, I'm familiar with Plaid.
Yeah.
Thank you. That answered my question. So for the rest of the audience, the Q&A is open. If you have any questions, you can enter your questions there.
So just to reiterate while we are waiting for any questions to come, so the next step here, when you click your QR code, would take you to a Calendly link where you can pick your convenient time for a half an hour call. It's a very conversational style call where we show us our tool, we can demo it to you, and then you can evaluate and then and get into Quantel. It's a very, very simple process. A lot of computation that X-ray does. It does what a human would take many, many days to accomplish in minutes. Going back in time to look at how a portfolio has performed over the last 3 years, or going forward in time is in terms of using the data to be able to predict with a range what the expected value is in the next n number of years, 5 years, 10 years, 15 years. So that kind of analysis is done in seconds and minutes that you can benefit. And then not only that, going into the 6 different dimensions that what Jerry was saying about, those are the various different aspects of a portfolio, that understanding that any one parameter is not healthy and correcting that would make a night and day difference in terms of portfolio's performance. And that's what we actually spend the most time on, is analyzing it and giving that information to our customers. And when we manage it, it's all embedded in the way that we manage things. We constantly look at all these different 6 parameters. We adjust and retune our portfolios. So when we manage it, you sit back and relax. You don't have to do anything at all, right? We open an account for you in Interactive Broker or Charles Schwab. Those are the 2 portals that we are partnered with. Your money stays with you, meaning your account stays with you. You're not mixing your account with anybody else. We are the advisors on the account. We operate the account with where to buy, what to buy, when to sell, what to sell, etc. But you are always in control of your account. We never, take ownership of the account. Money can only move in or out by you and you only. Whenever you want, you can take the money out. Yeah. So that's the kind of freedom that you operate with when you ask us to manage it, so that all the benefits, of course, all of the returns is obviously in your account. So you're not non-transparent about it. It's complete transparency there.
That is very safe, and we've learned through history why that's important.
Yes.
There are 2 questions in the Q&A, if I may. Renat is asking, growing the investment is great, but what about the tax optimization at the time of retirement?
Yeah, so we have this estate planning tool. So IRA account and 401k, you have no tax consequences during the time that you're growing. Only when you start withdrawing, it becomes part of your income as part of your W-2. So we have to not worry about tax implications by buying and selling. You buy today, sell in the afternoon, no taxes at all, no matter what it is, right? And obviously we won't do that. This is not day trading system. There's a more long-term system. But regardless, when you start withdrawing, we have this estate planning tool that optimizes how to withdraw to the extent that we can also suggest whether to convert into Roth IRA. And when you convert into Roth IRA, naturally, you pay a lot of taxes at that point in time. But if your account is growing at a healthy pace, converting it early on in your retired life, like taking to the maximum, let's say 100K per year for the next 8 years, would give you so much of money. At the age of 70, you're saying, I'm tax-free. Whatever growth is, that's yours to keep. And we're able to achieve that in terms of planning activities for the customers. You can, it's almost like a schedule that we give you to execute on, and we can also help you execute it along the way. So that's on the tax part of it. And we're very conscious of tax for the non-retirement account. If you have a non-retirement account with us, we make sure that the tax loss harvesting is done. We try to minimize your taxes. Yeah, we want to make a lot of money, right? Taxes is secondary aspect in that, but we do take tax into serious consideration to make sure that after the tax effect, you still are very profitable compared to whatever benchmark you want to compare with, right? So that's on the tax.
Thank you. And we had another question from Deepak. How are the fees structured? Is there a performance-based element to it?
Right. So on the investment advisory, it's purely a consultation-based approach. So we have 3 different plans. We can talk to you on a monthly basis, almost like your coach on your portfolios, for a 12 1-hour session for each month, right? That way, we are constantly looking at your portfolio. We are constantly giving our insights / education about what we think about your portfolio that you need to act on. Whether you act on it is up to you, meaning just like a doctor would give a prescription, he's not going to force you to take that prescription, right? So it's similar. We are doctors. We take the lab report, which is provided by X-ray. We give you recommendations. Whether you act on it or not is up to you, right? That's basically the way advisory works. So we have 3 different plans. We can do a monthly session, we can do a quarterly session, we can do a one-off session, like a single session that just analyzes your portfolio, and then you're on from there. You can, whenever you want, you can call us. So that's basically there. We can send the details for those interested. The second one, on the investment management part, we manage money on 2 different fee structure. One is a fixed fee, which we charge. Again, the details can be given on a one-on-one basis, not on this. But we have a fixed fee structure that they can choose. The investor can choose. I just want to pay a fixed fee every month, like whatever the fixed fee that we agree on, divided by 12, which is a monthly basis that we charge. Or it could be a fixed fee, a lower fixed fee with a performance fee added to it. That's only applicable to a qualified investor. Qualified, the term qualified is actually a SEC term, or a federal term rather, that says an investor need to have a $2.4 million of total assets. That doesn't include their house, primary residence, and so on. So if a person meets that qualification of being a qualified investor, then we can reduce the fixed fee and put a performance fee at the end of it to achieve the same result. At least we take a risk there that we need to work for getting the fees based on the performance. So if we achieve higher, we get a higher return. So when an investor makes more, we make more in that second category.
Very clear. Thank you for sharing that. Other questions from the audience in the Q&A?
Awesome. Great. Thank you, Dave. Thanks a lot for all the participants to come and join us for this webinar. So we are excited. We are going to be talking to a few of the folks that we get already some Calendly registration. So please use this webinar. We'll send the recording of the webinar for those who may not be able to attend today, but who those attended, you can re-watch this webinar at your convenience. Thanks a lot. Really appreciate your time. Yeah.
Thank you, Shyam. Thank you, everyone.
Bye.